It does take us to our talk of the tape. What is next for stocks and how much rides on NVIDIA's numbers next week? Let's welcome our guest. Jordan Jackson is global market strategist for JP Morgan Asset Management. Stephanie Link, Hightower's chief strategist and a portfolio manager and a CNBC contributor. Both here, as you can see, at Post 9. It's great to have you. Jordan, I'll go to you first. I mean, it's a momentous week, obviously, and I think the question on everybody's mind is, now what? What do you think is next?
I think we've got some further upside from here. I think we could see on another 5 to 10% upside from here. The reason being, you've got three puts. You've got the Fed put, you've got the earnings put, and you've got the consumer put. Right? The Fed seems explicitly biased to want to begin cutting rates at some stage. It's not a matter of if, it's a matter of when. Earnings are coming in. First quarter earnings came in a bit better than expected. You've got double-digit earnings growth being expected for next year as well. Most of the performance in the market this year has been driven by earnings.
Okay.
Now, the wild card there is consumers, right? If consumers start to get a little bit more tapped out, which there's certainly some early signs of that, that could become a challenge.
Steph, is that what sort of has confounded the bears, that earnings seem to have mattered more than anything else? And in my conversation yesterday, right here exclusively with Rick Reeder, when I asked him what happens next, I want you to hear what he told me, and you can react on the other side.
The earnings are actually pretty good. There's stickiness to margins, the software development, AI implementation, et cetera. It's pretty impressive. Earnings are still pretty good. And so anyway, I know we've talked about it a bunch of times. I think people underestimate. You got an incredible technical in equities. Could you get another 10, 15% of the equity market this year? I don't think it's much of a stretch at all. Could you get a bit more than that? Yeah, I think you could.
I was pretty surprised by that pretty bullish view, right? I mean, somebody, often called one of the bond kings, talking about, look, he's the head of global allocation, so he has hats in many rings. But what do you think?
He's brilliant, right? So I don't know if we get that much higher in the markets by what he's talking about. We're already up 11%, Scott, year to date. And the long-term total return average for the S&P 500 is 7.7%. For fixed income, it's 3%. So, okay, it's great that he's excited about equities. He should be. I think not enough emphasis this week is on the economy, though, because we wouldn't have good earnings if you didn't have a good economy. So you had to get both of those things right. And we've been talking about the above average growth rate for the economy. We're running at about a 3.6% GDP number. And we got good CPI, PPI was kind of a wash this week. Retail sales was a disappointment, but look at the 6-month moving average. You're at 3.1% in retail. So you got to smooth it out. It's too volatile each month. So the economy is growing because the consumer remains strong. Manufacturing, we've talked about. Housing is actually stabilizing. And quite frankly, that is leading to better than expected earnings if you add on the margin story, which was what Rick Reeder was talking about. Everyone wants to call the demise in margins, but companies, especially U.S. companies, are so good at restructuring, reorganizing, in pricing power, and in adjusting. And I think that's what we've been seeing this year, and we're going to continue to see it. So are we up another 11% between now and the end of the year? I don't know. We are going to be higher, I believe, because earnings will continue.
Higher than where we are now.
I do think so, Scott. Is it 5%? Is it 10%? I'd be surprised if it was 10%, because we have had a nice year and a half.
If you look at what we're calling the everything rally, because over the last 6 months, it kind of has been. It's not just the Dow and the S&P and the Russell. It's metals, gold and other things. Bitcoin is up a ton in the last 6 months. Are we surprised? Are you surprised, Jordan, that we were able to rally back as strong as we did from the April lows?
I'm a little bit surprised, because the market's been able to rally off of two very different narratives, right? Last year, the market rallied because the Fed was going to cut rates. This year, the market's rallying because earnings are good. And you continue to see a lot of durability in the equity market, right? Momentum tends to beget momentum. The market spends more time rising than it does falling, even though the average yearly correction, peak to trough correction, is 14%. The market's higher 75% of the time. So this is a market where, again, as was highlighted, companies are adept at managing margins. Consumers are going to continue to power top-line revenue growth. And so you put all this together, and the Fed is willing to cut rates, step in and cut rates. So I think this is a market that continues to grind higher.
What's going to lead us, Steph? I mean, I know that you're beyond tech. You own some tech, obviously, and You've been buying things like Apple. It's, I think, now your largest position.
Mm-hmm.
But whenever I talk to you, I feel like it's the cyclical mix trade. It's the industrials and the free ports, and we're going to talk about that later. Are we still going to be okay thinking that this broadening move is going to carry the next leg, or do I need to lean in large as I look ahead to things like NVIDIA next week?
I mean, I think NVIDIA is going to be great. I mean, when you have $177 billion of CapEx from the hyperscalers this year, that's a huge number, and that is going to benefit NVIDIA. But it's going to benefit many semiconductor companies and many companies in general. And that's a really big theme. It's so powerful because it extends to so many different sectors. We talk about industrials, which are cyclical for sure. However, they are benefiting from the energy transition into green, into clean, into grid, into power, into data center, and again, AI. And that sector has done quite nicely. By the way, just as well as technology year to date. Energy, that's also done better. It's taken a pause over the last month and a half, but I do think that sector is still ripe for higher action because those stocks are cheap and also because they're minting money. The free cash flow stories are so powerful. So I also think discretionary, which is very debatable right now.
Okay, well, let's debate it.
That's why I brought it up.
That's not only debatable, that's controversial.
Yes.
Just given what we've heard recently from the consumer, why would I want to buy discretionary stocks right now?
When I listened to Walmart, I was very encouraged. They're saying they are seeing a constructive consumer focused on value. By the way, who's not looking for value all the time? I'm looking for value. I'm sure you are as well. So that's a consumer that's I think that sounds solid. Private label, there's opportunities there.
You think the consumer's solid? Do you really think the consumer's solid?
Yes, I do. But wait a second. General merchandise, for the first time in 2 years at Walmart, was up low single digits. We haven't talked about goods in a really long time, and that was really encouraging to me. Yes, I do think the consumer is strong because we have the job market that remains very strong. Wages, we have higher home prices. We have higher equity prices. We have $6 trillion on the sidelines in cash. Yeah, it's getting 5%. That's great. But the fear of missing out, if you talk to Schwab, you're starting to see money pour back into the market because the market's up 11%.
Well, look, part of Rick Reeder's thesis here is that, to Steph's point, you have this divergence between the consumers. It's, at the lower end and the younger consumers hurting. Higher end, older consumers, baby boomers, are going to fuel the next leg of the kind of market that he thinks you can still have because of all the spending and investing power that they have. And that more than offsets the fears that we have for the lower end consumers who are being hit harder than most on the higher for longer and why inflation has remained so elevated for so long.
No, that's spot on. And we have to remind ourselves, remember, that 60% of consumption in the economy is driven by the top 40% of earners. Right, so long as the affluent and the upper folks earning income earners are in still good positions, then the economy can continue to grow. Right, these are folks where you got income growth, they can grow their consumption, and that's how you grow the economy. Now, certainly, when we look across our Chase universe and our Chase data, we can look at sort of income cohorts and how checking and savings account balances have changed since the fourth quarter of 2019. And unsurprisingly, the bottom quartile of income earners in our Chase universe, checking and savings account balances are down by 20% relative to the fourth quarter of 2019. So, look, those lower income consumers are certainly feeling it, but the folks who are going to drive consumption growth in the economy are doing okay.
Like, Steph, you need to be really selective, don't you? I mean, to suggest that, Walmart's commentary means that the consumer is just great and strong, I'm not sure. I
think the consumer is good. I don't know if I would say great. I think they're good, but they are still spending on services. We are seeing it across the spectrum.
Well, you have to spend on services, don't you, to exist?
Well, of course, but we root for that because that's 75% of consumption. So we want goods to do better. I was just mentioning that we haven't seen goods have any life in the last 2 years, and now we're starting to see it. So I just think that the job market is critical. If I worry about one thing, it's that deteriorating, but we're not seeing that yet. And let me just give you a data point on Bank of America. Bank of America does master trust data each month, and net charge-offs are 2.49%, and delinquencies are 1.3%. That's hardly horrible, right? That's actually historically low. And yes, so we are seeing an increase, but it's so gradual. You were 9-10% back in 2008 in these figures. So I just think that the consumer has a long way to go. It's all not perfect, but definitely there's places to make money.
All right,
sure.
So let's bring in CNBC contributor Malcolm Ethridge of CIC Wealth. He joins us once again, joins the conversation. It's nice to see you, too. So you've heard the commentary. You've heard some of the more bullish calls, and I'm wondering whether you think this Dow hitting 40K this week is a sign to get in or be a little more cautious.
Yeah, I think investors probably see the Dow hitting 40,000 to be their signal to say, let the good times roll. And to Stephanie's point, move some of that cash that's parked in the sidelines and those brokerage accounts into the markets. I'm starting to feel like a lot of my fellow skeptics have warmed to the idea that this soft landing has already happened and we can declare mission accomplished. But I am still concerned that what Powell is trying to accomplish, getting CPI down to 2%, is in direct conflict with the Biden agenda, right? So this is not a political statement. This is a statement of just common sense. I think that as we get closer to November, we are still in danger of seeing something in the system break because Biden is going to be doing what he can to get cash into the hand of consumers. Consumption will continue to go. And I think that's also...
He just can't... I mean, I don't know. There is a thing called the Congress. I mean, trying to get... more. Well, what do you think? More stimulus is going to come into the system? We're already worried about how high the deficit is now. I mean, what am I supposed to do with that?
Hear me out on this, Scott. So we just got earlier in the week the report from the Financial Times that it looks like it's at least possible that the proposal on the table from Freddie Mac to go into the secondary market now, extend HELOCs to homeowners who have $37 trillion, it's assumed, of equity trapped inside of homes. And the estimate is within the next 6 months, that would unlock about $1 trillion of additional equity out of homes. Where are those dollars going to go, if not into the same consumption patterns, those services that you guys just got done talking about, especially at the top end of the market, where the consumers who are homeowners have the equity built into those homes. So those kind of measures are what I'm concerned about. That's in direct conflict with us ever getting to that 2% number and getting that that first interest rate cut that we all covet.
But I mean, inflation is coming down. We know it. The Fed is going to cut before they tell you that, okay, it hit 2%. We know that also.
One positive report, one positive data point doesn't make a trend, though, Scott. So we can't necessarily say inflation is coming down and it is on its way to that 2% target anytime soon, simply because we saw one good report.
Steph, Malcolm makes the case that, rate cuts still matter. You make the case that they don't matter at all. And you don't think we're getting any.
No, I don't think we're getting any. I think that's because we have elevated inflation. But I'm taking it from the point of view we have elevated inflation, Scott, because we are growing above trend. I mentioned 3.6% growth here. Whether we're actually that number or not does not matter. Is it 2.5%, 3%? That's above trend. And that plus the global growth. Right, we talked about China growing 5.5% in their latest GDP. They actually just announced stimulus overnight. It's not big by any means, but it just shows you that they're willing to do something and do more, likely. We had the OECD raise global growth to 3.1%. We had IMF raise growth to 3.2%. So inflation is staying high because we're seeing better growth. And that, to me, I'd rather take better growth and a little bit more inflation because that will lead to better earnings. It's not going to get you multiple expansion, but it'll get you better earnings growth, something like 8 to 10%.
What do you think? Do we need? Hold on, Malcolm. I'll come to you in a sec. I promise. What do you think? Do we need cuts?
If you're a consumer, inflation's your foe. If you're a business, inflation's your friend, right? So the fact that I think we're in this sweet spot where inflation's a little bit elevated, but it's not eroding consumption. It's not putting the Fed in a situation where they have to come back to hike rates. Keep in mind, since 1980, the Fed has never gone on a hiking cycle, then paused and come back to hike rates. They've always cut rates. So the bar is very, very high for them to want to hike rates from here.
Powell told you as much.
Right.
I mean, most recently, we wouldn't even be having this conversation in the manner in which we are if Powell didn't do what he did a few weeks ago, where he wasn't as hawkish as some people feared, where he said, hikes are unlikely. That's the
data favors the
highly
bulls.
Unlikely, or whatever the exact wording he used.
The data favors the bulls.
Malcolm?
Yeah, Scott, I agree with what Stephanie just said about the unlikeliness that we will get a cut this year. but I disagree with the fact that they don't matter. I think that what does matter, we just got done talking about how strong the consumer is, and the tailwind behind that consumer at the top end of the income distribution is going to be the 5% plus that they're receiving on their deposits, on their CDs, on money markets, those kind of things, that they are spending those dollars on services today, and that is what is also helping to drive consumption. So as long as interest rates stay elevated, yes, they do hurt businesses' ability to consume, like Jordan is talking about, but they also improve individuals' ability to go and consume, which is a catch-22. It's 6 in one hand and half a dozen in the other.
Steph, can we talk about NVIDIA and what is really riding on this report next Wednesday for the overall market, for the AI trade? What do you think?
It's going to be great. I have no doubt about it. I just mentioned the capex that we're seeing in cloud and Gen AI at the 4 hyperscalers of $177 billion this year alone. It's tremendous. A lot of that is going to NVIDIA. The problem is NVIDIA is up 210% in the past year, so the expectations are high. I think if you do get some weakness, though, I think you're going to see buyers come in. Because if you believe we're in the second or third inning in AI, which I do, then they are going to benefit. But there are other ways to play it within technology as well. So I kind of have my shopping list ready. So if we do see a pullback in any of the stocks, Broadcom is, the one, and Lam is the other one that I own on that theme, I would be a buyer. But I think it's super important. It's 5% of the S&P 500 in terms of the weighting as well.
This may be the one conversation that involves portfolio managers on this network, all of whom do not own NVIDIA. I don't expect you to, because it's not your job to, run a portfolio, obviously, but Steph doesn't own it. Malcolm, you don't even own it, which is kind of a shock to me, because you own many of the other Mag 7 stocks. But I'm sure you have an opinion on what that report means for this overall market and perhaps the stocks that you do hold.
Yeah, I have said it on the network before, and I think it bears repeating, that our love affair with AI is nowhere near over. In fact, we're probably still in that early infatuation stage where we're just in love with all of the possibilities of what could even be. And so I think that NVIDIA will definitely come out and dazzle us no matter what. They're going to tell us about elevated demand levels, and as long as their receivables remain at the level they are in comparison to their inventory, I think it's a 2-to-1 ratio, right? Something like 10 billion in receivables versus 5 billion in inventories. As long as those numbers hold, nothing else really matters when we talk about NVIDIA. And as long as that trend continues, the AI wave can keep on rolling for multiple quarters before it finally gets interrupted.
Okay. You still like mega cap tech?
We do. I certainly say we don't view the Mag 7 as one monolith. Very different business.
Oh, they're proven to not be.
Right, sir. So that dispersion in performance itself is pretty significant. But one of the things I think investors can actually play on in this love affair with AI is actually sort of a second derivative, and that's in electricity providers, power grid infrastructure players. You look at some of those companies underneath the hood; they're up double digits, well into the double digits so far this year. And if if batteries, electric vehicles, chips, if we're going to be using more and more electricity in the years to come, I think those utilities are a great place to play.
All right, everybody, we're going to leave it there. Good weekend, Malcolm. We'll see you soon. Steph, of course, you're coming back in a little bit. We need to talk a little bit more about those metals on the move. Jordan, we'll see you soon too.